Hey, hello everybody. This is David Royer. I'm going to be hosting this webinar. I want to start out by thanking all of you for being on today. This webinar is scheduled to last just a little bit under 1 hour. You will be muted during the entire presentation, but there is a box where you can type in questions. Should have popped up on your screen, and we'll be sure that somebody gets back to you to get those answered. And also I want you to know that this webinar is going to be recorded, or actually is being recorded, and everybody who's registered for the webinar, whether you attended or not, you'll receive the recording sometime later this afternoon. So with that, I'm going to go ahead and get started. Just to give you a little bit of background, back in 2002, we saw some, and since then, we've seen some major changes in the tax code that affect IRA and 401k distribution planning. So beginning in 2002, I saw this as a tremendous financial planning opportunity, and I began to build the course, Keys to the IRA Kingdom. This course is designed to help advisors learn expertise in IRA distribution planning so they can better serve their clients that have these types of accounts. We launched this course nationally in 2004, and to date, we've had over 5,000 individuals attend the Keys to the IRA Kingdom. So moving forward, the slide to change here. There we go. This particular broadcast is being sponsored by Insurance WebEx Web Classes, and that's America's leading source of educational web classes. A little bit about my company. I'm the president of DLCA Enterprises, and let me tell you first what we are. We are a company that helps advisors get involved in the IRA 401k rollover business. We have educational courses that are online. I've also developed a book that helps you prospect called Keys to the IRA Kingdom, or rather called Top 10 IRA Mistakes, and we'll get into that in just a moment. But let me tell you what DLC Enterprises is not. We are not a field marketing organization. There's no contracting involved with this. It's strictly educational and marketing. So it's really about selling more annuities, life insurance, and managed money to owners of qualified accounts. And that includes IRAs, 401ks, 403bs, SEP plans, TSP plans, etc. So we developed two tools to help you, one, get prepared for the market, and the second, to help penetrate that market. And the first tool is the Online Advisors IRA Distribution Training course called Keys to the IRA Kingdom. So this is actually an IRA 401k rollover training system. It's all online. And then we developed the book Top 10 IRA Mistakes and How to Avoid IRS Tax Traps. And that's part of an IRA 401k rollover marketing system. These two in tandem are extremely effective. So that begs the question, why would you want to focus on the qualified market in your practice? I'm going to give you a lot of reasons. One, we know that 401k plans have all but replaced defined benefit pension plans. And that's a good thing, particularly if you're a financial advisor, because 401k plans, this is money that is movable, where the defined benefit pension plans were not. We have 10,000 boomers that are making IRA 401k rollover decisions every day. And most boomers' 401k plans have more value than the equity in their home. And I'm just saying that so you understand how important these plans are to them. We know that over 70% of 401ks, 403bs, and TSP plans allow what's called an in-service rollover at age 59 and a half. And that simply means they can, if they're concerned about how their mutual funds are doing in their 401ks, TSPs, etc., they can roll that money out to an IRA, put it in a safe place, hopefully, and still continue to make contributions and continue to get company matching funds. So knowing about that's really important. In addition to that, there's 4,000 seniors turning 70 and a half every day with no formal distribution plan. LIMRA estimated, now this is a slightly dated number, I'm going to give you a fresher one here in a moment, $25 trillion in America's retirement assets. And also, LIMRA has predicted that the IRA rollover market is going to reach $5.15 billion, or $515 billion, and that's going to happen this year. So that's really where the opportunity is. More reasons. We mentioned defined benefit plans are a thing of the past, so most boomers are going to retire primarily depending on their 401ks, IRAs, et cetera, and Social Security. So Social Security and 401k plans have become big hot buttons for the boomers that are retiring. And soon, they're going to represent the majority of the retirement market. So Why focus on the qualified market? Because that's where the retirement market's growing. So I'm going to give you some facts to back that up. And first thing we're going to look at is total IRA assets in billions. And this is current right through the first quarter of 2018, almost $9.2 trillion in IRA accounts. And you can see the growth pattern from 2000 through 2018. It's about tripled. Now let's take a look at the 401k plan assets in billions. And that's grown at the end of the first quarter to $5.2 trillion. Now, I want you to notice something. I'm going to go back to that last slide. $9 trillion, almost $9.2 trillion in IRAs, $5.2 trillion in 401ks, and notice these 401k numbers are beginning to drop. Let me tell you what's happening here. Many people in 401k plans are making the decision to take control of those accounts and roll them into an IRA, making the entire universe of investment options available to them. And this trend is going to continue. Now, if you want to look at the total assets, retirement assets in trillions, you can see at the end of the first quarter of 2018, it was $28 trillion. Earlier, I gave you that number of $25 trillion. Well, that was a 2016 number. It's already grown roughly $3 trillion in just a handful of years. So the market's growing rapidly. Now, here's another trend that's worth looking at, and this is the trend of individuals aged 65 and older in the United States. Now, this chart goes all the way back to 1900. I know you don't care about that, but it's projected through the year 2030. But if you look at it today, we have roughly 10,000 baby boomers retiring every day, making decisions about what they're going to do with their 401ks, 403bs, TSP plans, etc. In less than 10 years, they are going to control the overwhelming wealth of this nation. And so why is this important? This is the biggest financial event in the history of the financial services industry. So I want to spend a moment before we get into what I'm going to be teaching you today, and I want to talk about accumulation versus distribution. We are in the distribution business. Now, let's talk about accumulation. That's the phase when people are making contributions to their IRAs, 401ks, 403bs, and whatever type of plan. And during that accumulation period, life was really very simple for these participants. And the reason is they only had three considerations. One, am I eligible to contribute? Two, how much can I contribute? And three, where do I want to put the money? So life was very simple. The IRS wasn't watching closely. They were getting a tax deduction. And it was a very easy period. And you know, most advisors are still in that accumulation phase where they're helping their clients accumulate and grow their money. Now let me talk about distribution. When these individuals turn age 70 and a half, or when they need cash flow, and they begin to take distributions from these plans, the Internal Revenue Code is strewn with landmines. Now it becomes very complicated, and the reason is now it's IRS payday. They're being forced to take taxable distributions. So we're going to be talking primarily about the distribution phase because this is where the 401k and IRA rollover industry is headed. Now, where the qualified money is just as important as how much there is. And what we learned from the Investment Company Institute, 47% of that roughly $28 trillion is in mutual funds. There's another 36% in other securities. Banks and thrifts have 10%, and insurance companies have a mere 8% in the form of annuity reserves. If you had the technique to show your prospects and your clients why, when they go from that accumulation phase into the distribution phase, why would an annuity held by an insurance company be ideal for at least a portion of their IRA? That would be very powerful information. But let's sum this up. If you add the 47% that's in mutual funds to the 36% in other securities, you'll see that 83% of that $28 trillion at one form or another is at risk on Wall Street. Right now, the markets have been at an all-time high. We're coming toward the end of a 9-year bull run. I cannot predict what's going to happen next, but I think it does create an opportunity for annuity, life, and managed money producers. So this is really about how do you become an IRA rollover expert in your market area? How do you get in front of qualified prospects who have these large IRAs, 401ks, etc.? How do you attract these people to you? How do you capture those rollover accounts? And How do you become an expert in in-service transfer? Folks, there's a lot of this happening today. There's a lot of people that are hitting 59.5. They're in 401ks. They're worried about the market. They don't know that they can roll that money out of the 401k into whatever safe vehicle they want to put it into and still continue to make contributions and still get company matching funds. So that's big business. So it's how to use IRA and 401k rollover opportunities to grow your business. So now we're going to get into the training part of this. Today's featured subject is going to be based on my book, Top 10 IRA Mistakes. So it's a top 10 mistakes that consumers make, and we're going to spend a little time talking about what they are and how you fix them. So I'm going to jump right into mistake number one, because ladies and gentlemen, this is the most common mistake made not only by owners of IRAs and 401ks, but by their beneficiaries as well, and that is missing a required minimum distribution. You see, the first distribution has to be taken or is due by April the 1st of the year after they turn age 70 and a half. All future distributions must be made by December 31st of subsequent years. If they miss one of these required minimum distributions, that's going to result in a 50% excise tax. In other words, the IRS is going to take away 50% of that distribution. And so this is, as I said earlier, this is the number one mistake IRA owners and their beneficiaries make. So I'm going to walk you through the numbers real quick. Here's an example. Let's say based on this individual's age and the amount of their IRA, their required minimum distribution was $10,000. December 31st is come and gone. For whatever reason, vacation, illness, whatever it was, they didn't take that distribution. Here's what's going to happen. They're still going to have to pay tax on that distribution. I'm estimating that at $3,000, 30%. That may include federal and some state income tax. But then, in addition to the tax, the IRS goes up to this distribution, and 1/2 of that becomes an excise tax, which is a polite word for severe penalty. If you add the penalty and the income tax together, they'll wind up paying $8,000 to the IRS. So what just happened here? They made a mistake, and now $8,000 goes to the IRS and only $2,000 goes into their pocket out of that $10,000 distribution that was meant for their retirement needs. And folks, again, this is the number one mistake that IRA and 401k owners are making. And when this happens, essentially, the IRS just became their senior partner in that missed distribution. Let's move on to mistake number two, and that's not taking advantage of the stretch option. You know, I've seen numerous attempts by different government agencies to put an end to the stretch, and they have all failed. The stretch is well, it's alive, and it's still an excellent financial planning tool. So essentially, I'm going to show you an example. I'm going to use the Bunkers family, and let's say Archie's got a $200,000 IRA, and I want to show you how the stretch option works. So what we learned when we met with Archie and Edith is that they were both 65. They had a daughter, Gloria, age 35, and 2 grandchildren, ages 6 and 2. And when we asked Archie and Edith, if there's money left in this account when you're gone, where do you want it to go? And here was their answer. Well, we want 50% to go to our daughter to help raise our grandchildren, but we want to give a gift directly to those grandchildren in the form of a check every year around their birthday for the rest of their lives. So I want to leave 25% each to directly to each of those 2 grandchildren. So that would use up 100% of whatever is left over. Now, let me show you the end result. And we're going to assume a 5% rate of return. I know right now interest rates on annuities are a little bit lower than that. Some annuities are earning much better than that. But over the long run, 5% is a pretty safe number. So let's assume Archie lives to his normal life expectancy, takes out only his required minimum distribution. He will have withdrawn $177,000. We're going to assume Edith is going to survive Archie by 4 years. And if Edith takes only her RMDs, that'll total $71,000. Gloria, who got 50% of that account, spreading these RMDs over her life expectancy, it'll total $265,000 and over $300,000 for each of those 2 grandchildren. So what happened, by using the stretch option and setting these beneficiaries up correctly, we have leveraged a $200,000 IRA into total stretch distributions of $1.2 million. In other words, we generated an additional $1 million of income by setting this up properly. Now, to set it up properly, You got to make sure the beneficiaries are set up right. So mistake number 3 in the book is not properly designating beneficiaries. This is important. Only a designated beneficiary, and that is an IRS term, can stretch these distributions over their individual life expectancies. The next thing you need to know is only the IRA owner or inheriting spouse can designate these beneficiaries for the purpose of stretching these distributions to the non-spousal beneficiaries. Okay, what does that mean? That means this is something they have to do today while they're alive. After the owner and the surviving spouse are gone, it is too late to designate beneficiaries, and all the taxes will have to be paid in 5 years. So since we're talking about beneficiaries and how to set them up, there's 2 ways to set up these non-spousal beneficiaries. One is called the 2-tier approach, and unfortunately, that's what most advisors are doing. I'll prove it to you in just a moment, and it's a mistake. The other is the 1-tier approach, which is the correct way to do it. So let me explain how this works. And knowing the difference between these 2 approaches is going to be critical to your clients and critical to how much total income is going to be paid out of that IRA over these 3 generations. So let's talk about the 2-tier approach. This is how most IRA beneficiary forms are set up. The IRA owner designates the spouse as the beneficiary, and then as contingent beneficiaries, let's say in this case they designate their 2 children. Now, they didn't designate the grandchildren, but one of these child number 1 on the left has 2 grandchildren. Well, guess what just happened? Folks, these grandchildren just got disinherited. Remember what I told you earlier? Only the IRA owner and spouse can designate a beneficiary for stretch purposes. The grandchildren are completely left out. So here is the 1-tier approach, and folks, this is the key to capturing the account. So please stay with me very close, because this is one area. The beneficiary form is the conduit to the sale. So let's go back to the 1-tier approach. The IRA owner selects the spouse as a beneficiary, and then the contingent, again, are the 2 children and the 2 grandchildren that all inherit on 1 tier. They inherit at the same time. So the children and the grandchildren are all now contingent beneficiaries. Well, guess what just happened? The IRA owner and spouse designated the grandchildren this time, and as a result of that, the grandchildren are designated beneficiaries and cannot be disinherited. Now, I'm going to prove to you in just a moment, when you sit down with a client and you look at their beneficiary forms, almost all of them are going to be on the 2-tier approach, and it's a mistake. And again, that is the conduit to capturing that account. So how do you use this information to capture IRA rollover accounts? Here's simple. Most IRA beneficiary forms are set up using the 2-tier approach. They set the spouse up as primary and the children as contingent, and the grandchildren are excluded. Here is how you start the conversation. When you look at that, and you guys have 9 out of 10 times when you sit down and look at a beneficiary form, it's going to be that way. Spouse primary, children contingent. When you see that, ask this one question. We'll help you capture that rollover account, and here it is. To Mr. and Mrs. Jones, there's really nothing wrong with the way you set up your beneficiary form, but let me ask you one question. Are you intentionally disinheriting your grandchildren? And folks, I guarantee you, when you ask these IRA owners and spouses if they're intentionally disinheriting their grandchildren, you are going to have 100% of their attention. Everything you say after that, they're going to pay very close attention. So here's how you make this work. You run 2 stretch IRA illustrations. You run the first one as their beneficiary form is already set up with child only as contingent, and then you run a second illustration showing the child and grandchildren on that 1-tier approach as contingent beneficiaries. So I'm going to show you the end result of that right now. So we're going to use the bunkers again. Archie's 65, Edith 65, Gloria's 35. They have 2 grandchildren, ages 11 and 14. They have $200,000 in their IRA. Here's what happens with the 2-tier approach. The child is going to be 100% contingent. So Archie's going to take out his RMDs. Again, we're assuming Edith lives 4 years longer. She'll take out her RMDs. The child then will inherit what is left over, spread it over their life expectancies, $584,000. Total RMDs paid to the owner, the spouse, and the children, $797,000. Now I'm going to show you the proper way to do it. In this situation, I would recommend, and the percentages are going to change with circumstances, but as a rule of thumb, let's leave 60% of this money to your child and 20% each to your grandchildren so that they're not disinherited, so that you've named them as contingent beneficiaries. Here's what will happen. Archie's normal RMDs over his life expectancy, 177. Edith, 34,000. She's going to live 4 years longer. Now, you notice the child is going to drop from 584 to 350. That's because we're spreading some to the grandchildren. But look what these grandchildren are getting with just that 25% that they inherited, over 200,000 each. Total RMDs or distributions, 1,029,000. So, folks, that's 700, almost 800,000 versus roughly a million. It's 231,000 higher stretch payout, and it didn't cost them anything to do it. All they had to do is change their beneficiary form to include those grandchildren. And guess what? When they're changing things, when they're changing the beneficiary forms, maybe that's a good time to change custodians. That also may be a good time to change advisors. Ladies and gentlemen, that's what puts that money in motion. And let me just share something with you. Those of you that do consumer workshops, or you meet with a client and you invite them into your office, typically what as advisors, we ask them to bring in their statements. Let me tell you something. That scares them to death. That telegraphs to your client, I want to know how much money you have. I want to know where it is because I want to take control over it, and that scares them. What if you change that to, we can look at your statement sometime, but the important thing is I want to look at your beneficiary forms because that's where most of the mistakes are, and typically I can fix that at no cost to you. So bring in your beneficiary forms. Well, let me tell you what will happen. They're going to walk in with their beneficiary forms, and they're going to have tucked in a folder. The statements will be right there with them. And when you show them the mistakes on that beneficiary form, the statements will come out automatically. Let's jump into mistake number 4, and that's not establishing separate accounts. The separate account rule is extremely important. Why is it important? Because beneficiaries have different ages and they have different life expectancies. So, for example, a 12-year-old grandchild that inherits part of that IRA has a life expectancy or payout period, or you could call it deferral period, of 70.8 years, where the 45-year-old mom will have a life expectancy of 38.8 years, or that's their payout or deferral period. So without separate accounts, both of these are going to receive income based on that shortest life expectancy, that of the 45-year-old mom rather than the 12-year-old grandchild. So let me put some numbers to that. We have a $200,000 IRA. Our beneficiaries are ages 45 and 12. So it's the 45-year-old daughter and the 12-year-old grandson. At death, without separate accounts, here's what's going to happen with that $200,000. Let's say the owner decides to leave $100,000 to his daughter, 45-year-old, and $100,000 to that 12-year-old grandson. So they each inherit $100,000. If accounts weren't separated, they're going to have to use that same life expectancy of the 45-year-old at 38.8 years. In other words, they're going to get treated the same. So again, at 5%, the 45-year-old's total distributions from that $100,000 inheritance over her life expectancy of 38.8 years, $313,000. Grandson is being treated just as if he's a 45-year-old. It's going to be identical. Add the two together, total distribution $626,000. Well, that doesn't look bad. We started out with a $200,000 IRA inherited by the daughter and the grandson, and it paid out $626,000. Looks good until an expert shows them what happens with separate accounts. Now, the same thing happens. The daughter inherits $45,000. The grandson inherits, the 45-year-old daughter inherits $100,000. The 12-year-old grandson inherits $100,000. But this time, they're going to get to use their individual life expectancies. The daughter, 38.8 years, but here's the big change. This 12-year-old grandson now gets to use his life expectancy or deferral period of 70.8 years. So for the daughter, it's going to be exactly the same. But now we're using a longer life expectancy for the grandchild. That $100,000, instead of paying out $313,000, folks, it tripled to $945,000. The reason we went from a 38.8 year deferral period to now a 70.8 year deferral period. Total of all distributions jumped from $626,000 to 1.2, almost 1.2.5 million, 1,258,000, just about doubled. Let's jump into mistake number 5. Too much IRA at risk. Now, please, those of you that are money managers or in the securities industry, don't misunderstand me. I'm not saying that they shouldn't have securities in their portfolio. But what I am seeing, and I know what a lot of you on this call today are seeing, is that people in their late 60s to mid 70s, all the way up to 80, have 100% of their money at risk in the market. And right now, we're had almost a 10-year bull run. There's a high likelihood, and a lot of the analysts are saying we're due for a correction. So I'm saying too much at risk is a mistake. So if they're going to need income from that IRA, or they want to leave that legacy to the family, risk is the fastest thing that can ruin their plans. I mean, 2008 is still fresh in our minds, but let's go back to the early 2000s when the tech bubble crushed. And what is going to be the next bubble? Well, probably is going to be the money bubble. That's what a lot of the experts are saying, but something's coming. So anyhow, I'm going to give you a couple of famous quotes, let you guess. You can type this into the box on your screen. Tell me who said this. The most powerful force in the universe is compound interest. Okay, I know some of you are guessing right now. I'm going to give you the answer. That was Mr. Albert Einstein. Here's a more current quote. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Who said that? Legendary investor Warren Buffett. And you know something? Even Berkshire Hathaway wasn't able to follow either of those rules in 2008. Everybody lost money. Now I want to get back to Einstein's quote, the most powerful force in the universe is compound interest. And I'm just going to show you, if somebody had $200,000 and they were going to invest that, and the date is January the 1st, 2000, and they're going to put $100,000 in an account that's going to perform identical to the S&P, and they're going to put another $100,000 in a fixed account that is going to compound at only 3%. Now, as interest rates are coming up right now in these fixed accounts, this is probably kind of a lowball number. But let's see what would happen. Well, the first 3 years, we had the tech bubble crash. We lost 10, 13, then 23%. The 100,000 that went into this account is now worth 59,000. This is kind of the story of the tortoise and the hare. At the fixed account at 3%, it's 109,000. So they're going to be happier at this point with the money they put in that fixed account. But what has to happen when you take a loss in the market? Well, you need some good market years to get your money back. And that is exactly what happened. 2003, it came roaring back, S&P 26%, 8.3, 13.3, and it worked. They got back to almost the 100,000 they deposited by the end of 2007. But look at the fixed account, 126,000. Now, let me ask you something. What if they wanted to retire the following year in 2008? The S&P took almost a 40% hit. This account now is down to 61,000. They got 130 in the fixed account. A lot of people in 2008 had to reschedule their retirement dates or delay their retirement and rebuild their IRAs and 401ks. Worse yet, there were people that were already retired and lost as much as half the money that they had invested, and they were seeking employment in 2008 and 2009 when unemployment was double digits. There weren't any jobs to be had. These people were in a really sad state of affairs. But as all things go up and down, it did go back up. We had 2 great years, 2009, 2010. But you're only back now in this account to 85%, or 85,000 of that original 100. Here you're at 138. Then we had a flat year, and then we had another pretty much flat year, but we had 5 great years in here. The bottom line, in that S&P account, by the end of 2017, it would have had a little bit more than that 3% account. Would have had 182,000 versus 170. Now, if we see 2018 pop up with the negative, this is going to probably reverse. So my point is, hedge your bet. It's okay to be in the market, but have something in a fixed account so that you know that you're going to make some money every year. Now I'm going to get into mistake number 6. And that's overpaying fees and loads on IRAs, 401ks, and other retirement accounts. I'm not going to run through a bunch of slides on this one for the sake of time, but let me just say this. 401k accounts have a lot of hidden fees. They're not on the prospectus. They don't show up in the statement. You see the balance, but you don't see what was taken out. These fees and loads over time could literally cost them more than the income tax. Now, a person may be very comfortable with whatever fees or loads they're paying on their mutual funds, but most of them don't understand when securities are bought, sold, or traded within a mutual fund, there is a commission paid. And guess who's paying the commission? Well, the person that owns the fund. So I just would say this. I believe people owe it to themselves to find out what they are paying in fees and loads and what are the hidden charges. And if they're still comfortable with that account, great, but they owe it to themselves to find out. Let's jump into mistake number 7. I'm going to elaborate on this one a little bit more. And that's not considering tax-saving strategies. So this is chapter number 7 in the book, Top 10 IRA Mistakes. We talk about 2 things in that chapter. One is life insurance arbitrage, using life insurance to generate tax-free income. The other is the Roth conversion. For the sake of time today, I'm just going to spend time on the Roth conversion. So let me say this. From the first day that they contribute to that qualified plan, guess what? Uncle Sam became their partner because they didn't pay tax on that money, and he's putting those IOUs in his wallet every day. Then everything goes well. You turn age 70. Your family's around you. Happy birthday. Folks, 6 months later, the same person's going to turn age 70 and a half, and guess what happens then? There's a knock on the door, and that's your partner coming back with that contract. Hey, remember, this IRA is not yours, it is ours. Part of your IRA is that IOU to the IRS. And oh, by the way, I'm going to tell you what percent you have to pay me because they're controlling the tax code as well. So the Roth conversion may be the best solution for some. You have to pay tax on it when you convert, but Roth IRA owners are not forced to take distributions. So if they don't want to, they can just let it continue to accumulate. All future gains and distributions are income tax free, and beginning January the 1st, 2010, anybody can convert whatever amount they want from their traditional IRA or 401k to a Roth IRA. So for some people, folks, a small tax bite today could save a fortune in taxes tomorrow. Well, let me give you an idea here. A lot of the reason why people don't want to convert to a Roth, and you'll hear them say this, it's going to jump me up to too high of a tax bracket. If I convert my $200,000 IRA to a Roth and add that to my current earned income, I'm going to be in the highest marginal tax bracket. Well, they don't have to do that. There's this thing called tax bracket targeting. Let's say, for example, they could earn another $30,000 a year and stay in the same income tax bracket they're in today. Well, that's not difficult. Just convert $30,000 a year, and the tax bite will be smaller until it's all converted. So they don't have to do it all at once. Chapter number 8 in the book, or mistake number 8, is not moving your 401k, 403b, TSP plans, and other company or government-sponsored plans to the more flexible IRA. Folks, in this section, I'm going to give you some pure logic. You can walk away from this webinar and use this immediately in your practice. And this is also chapter number 8 in the book. Retirement assets in this country, the government sponsored plans in the 4th quarter of 2017, some of those current numbers I could get, and that's from the Investment Company Institute. There's $4.8 trillion in 401k plans, $905 billion in 403bs, $467 billion in federal employee TSP plans, and $282 billion in 457 plans. So it's a lot of money. There's a lot of opportunity there. So if you think about this, here's where the logic comes in. Why would somebody participate in a 401k, 403b, TSP plan? There's only one reason. There's a lot of downsides. You got to play by the rule book. You can lose access to your money. You have limited investment options. Most of it's in mutual funds. Most of them don't have any kind of fixed options. So why would you put up with all that? One reason: employer matching funds. Folks, they do it to get that free money. Here's the point. When the contributions stop, the free money ends. So if they've left that company and they've left their 401k behind, maybe they retired, maybe they went to work for another company, or they just decided, I'm not going to make any more contributions, folks, it's time to get the money out of the plan, because the only reason to be in that plan is now gone forever. So what should you do with the 401ks, 403bs, etc., when you retire or turn 59 and a half? You have 2 choices. It's really pretty simple. You can leave your money in the plan, or you can roll the plan to a more flexible IRA. So let's talk about leaving your money in the plan. Let me tell you what happens when people retire. The last stop is the HR department, and the first question is, what do I need to do with my 401k? 100% of the time, The HR person is going to say, you don't have to do anything. You can leave it right where it is. You don't have to touch that until you turn 70 and a half. And you know what people want to hear? They want to hear you don't have to do anything. They need to hear what their options are. So here's what happens if you leave your money in the plan. The plan guidelines can restrict your access to your own money. Your investment options are limited to what's offered in that 401k or 403b, etc. You have limited distribution flexibility to the children and the grandchildren because they don't offer the stretch option. And there's no more free money. If you're not making contributions, you're not getting the free money. You've lost the one reason to be in the plan, yet you're still facing some problematic risk. Now let's compare that to rolling the plan to an IRA. You know, one of the things that these plan custodians will tell everybody is, well, you can do that if you want, but we're going to withhold 20% to pay taxes. It isn't true. If you do a direct rollover, custodian to custodian, the 20% mandatory withholding is waived. They can roll 100% of their money. Their money continues to grow tax deferred, just like it did in the 401k plan, but now the consumer has control over where the money's invested, and the entire universe of investments opens up to them. IRAs offer Roth conversion. They offer the stretch option, and depending upon where they roll that money to, they can eliminate all or some of the risk. So when you compare the two, leaving it in the plan versus rolling out of the plan, I think this is pure logic, and consumers are going to understand this, and they will act on it. So here's the opportunity. Most 401k and 403 plans offer only mutual funds, markets at an all-time high. In-service transfers to an IRA can protect the principal. Excuse me, remember that's at age 59 and a half. They can do an in-service transfer, protect the principal from a downturn in the market, and plan participants can continue to make contributions and get company matching funds. So by doing that at 59 and a half, they're really getting the best of both worlds. They're protecting their principal, and they're still getting the free money. So it's a great maneuver, and it's a great logical story to tell your clients that still have that money in the 401k, whether they're working or not. Because, folks, 401k and 403b planning and TSP planning, et cetera, it can eliminate very costly mistakes for your clients and also for their families. Let's move on to mistake number 9. This is one I know you're going to relate to. Too many retirement accounts. You know, the average American today at retirement age has their money in 9 to 10 different places. Now, if you just look at all the mistakes that we just went through that people can make with their retirement plans, well, if you have 10 different accounts, then your problems are multiplied tenfold. You have 10 times more opportunity to make one of these mistakes. It just doesn't make any sense. During accumulation, hey, that's great, diversification. But when you go into that distribution phase, why not simplify these qualified plans, put them into 1 or maybe 2 different buckets, and so it's easily managed. It just makes good sense. Now I'm going to get, and the reason I went over that one briefly is I want to spend more time on this one. Folks, in the book, this is the mistake that is going to drive your consumer back to you to get a second opinion. I introduced this by the granddaddy of all mistakes, is not getting a second opinion. And here's something else. Write this down. It is impossible to get a second opinion from the person that gave you the first opinion. Let me say that again. It's impossible to get a second opinion from the advisor that gave you the first opinion. So let me elaborate a little bit. Let's talk about your health. Let's say you went to your doctor. Everything's been going fine. You see them maybe once a year, maybe when you feel sick. Among the other things they do, they listen to your heart. And on this particular visit, your general practitioner or your family practitioner listened to your heart, and he looked at you and he said, Bob, I hear something wrong in there. Something doesn't sound right on the heart. So here's what I want you to do. Stop at the nurse's stand when you leave, and I want you to make an appointment for 6 a.m. next Tuesday, and come on in, and I'm going to do open heart surgery. Well, that's absurd, right? Would a family practitioner want to do open heart surgery? Well, of course not. What's he really going to do? He's going to refer you to a cardiologist who may refer you to a cardiac surgeon. The system is set up to get the patient to the individual that has the training and the expertise to do what needs to be done. Now, let's talk about your wealth. No such system exists. So going back to your health, why does that system exist? If Bob's general practitioner spotted something, sent him to a cardiologist, and Bob got fixed and he's healthy again, he's going to keep that general practitioner forever. But when a financial advisor refers a client to somebody that has expertise in the area of IRA distribution planning, they are likely to lose management of that money. So on the health side, the system works. On the wealth side, getting a second opinion, you really have to go out and reach out for one. And I make a big point about the different types of advisors you're going to meet and why they're not going to recommend that you see somebody that has expertise in IRA distribution planning. So folks, a second opinion from a trained IRA advisor can save family fortune in fees, taxes, and loads. So we just went through, what we just walked through, this part of the course, Keys to the IRA Kingdom, that has also been turned into the book, Top 10 IRA Mistakes. It's really about IRA rollover marketing and IRA rollover training. The book Top 10 IRA Mistakes is updated annually, so it will always be relevant. We've had a lot of advisors have called me and said it's been very effective building relationships with CPAs and other professionals, and just for the simple reason is even though they may want to refer you, they may not know how. So by giving the CPA this book to give it to his clients and say after they read it, have them call me, that's been very effective for some advisors. If you want to know more about the book, you can go to www.top10IRAmistakes.com. So we have an estimated $324 billion being rolled from plans to IRAs each year. America has now close to $28 trillion in retirement assets. We have 10,000 boomers making rollover decisions every day. Folks, this book's designed to help convert your IRA prospects into clients because it's going to help them understand why getting a second opinion from you, the trained IRA advisor, can save them thousands in penalties, prevent rapid taxation, and reduce excessive fees and loads. At the end of each chapter, we've made the book interactive. This is at the end of the beneficiary chapter. They can have a place where they can take notes. They can write down their areas of concern. If you flip the page over, it's got a section where they can put in whatever additional information they have. So when you give them the book, point that out to them and say, so when you come back, be sure to make your notes in here. I'm going to answer all your questions and provide you whatever additional information that you ask for. Something that we did recently, we now can personalize this book with your photo and bio on the back cover. We are not inferring co-authorship. It says very clearly up here, this book is provided to you by, and then we have the financial advisor's photo and information. To get these custom cover books done, we do it through Digital Book Designs. They're out of Missouri. They're top drawer, state-of-the-art cover designers. They charge $90 to put you on that back cover. Now, if your securities licensed, the one thing we have to insist on, we've done our FINRA and our research, your securities disclaimer has to be at the very bottom. Now, something else, let me just tell you the cost of these books if you have interest. We sell these custom cover books in cases of 50 because we just can't print them less than 50 at a reasonable price. So a case of 50 books with custom cover with you on the back is $530.50. That includes shipping. So when you take out the shipping, your average cost per book is $9.45. And incidentally, the book retails for $19.95 without your cover on or without your photo on the back cover. Then we decided to do something new. You can now get the book without my photo on the front cover. Now here's Ron's book. You can see my photo on the front cover. Here's Ron, provided by on the back cover. Now watch what happens when we take my photo off the front cover. You notice how much more attention that attracts to Ron? I've got my name here. I don't need my photo there. Let's do it again. Let's go back. Here it is with me on the front cover. And here it is. The only thing we changed here is we took my photo off the front cover, and all of a sudden, Ron's photo pops out. So that's a choice that you can make. So anyhow, the complete IRA 401k rollover system, it starts out with what has been referred to as a seminar in a book. Essentially, this book is a seminar. And the Keys to the IRA Kingdom, which is 10 hours of online IRA distribution training. So I'm going to kind of walk you through the course. The Keys to the IRA Kingdom is now online, on demand. You don't have to buy a plane ticket, a hotel room, or pay for meals. Any place where you've got a smartphone, an iPad, a computer, and you've got high-speed internet, you can take the course online. I am the host through the entire course. And the good thing about taking the course online as opposed to attending it live is when I do live training, it's a day and a half. and I have to go at a certain pace to get it done. It's a lot of information. It's 10 hours of talk time. You cannot rewind me or fast forward me, but in the course, when you're doing it electronically, you can do whatever you want. You can jump from one module to another, go back and review another one, rewind it, make me say something as often as you want me to. You're in control. So you can take the Keys of the IRA Kingdom course online, on demand, at your pace. Those that register, you're going to have access to the online training room 24/7, and it's approximately 10 hours of IRA distribution training. It's filled with sales techniques. I do have to go through some of the technicalities to build up to the sales technique, but this is really about how you develop techniques in your practice that are going to help your clients and help you capture those accounts. After you register for the course, and I'll tell you how to register in just a moment, within less than 24 hours for the course, you're going to receive an email, and inside of that email is going to have a big link right here, and you'll get a username and a password. Click on the link, enter the username and password. You can begin training immediately. All training materials are going to be delivered within 5 days after registration, and that includes an IRS Publication 590. I refer to that a lot, particularly in the beneficiary section. And also, you're not going to spend all your time writing. We're going to provide 74 pages of pre-take and typed notes with all the graphics, all the charts, and all the sales techniques so that you have a permanent record. Now, my course, if you went to my website right now and tried to buy my course, it's $1,295. Incidentally, my website is irakeys.com. But because this is sponsored by Insurance WebEx, they have really negotiated on your behalf. So everybody on this broadcast, because it was sponsored by Insurance WebEx, will receive a 50% discount. So that would take it down to $647.50 would be your cost. Now, to do that, you're going to need to call or email me to get the promotional code. I used to give that out in the webinars, and it got spread around too much. So to get the promotional code for the 50% discount, call this number, 214-705-0124. Call that number, and we can get you enrolled in the course. And we can discuss books if you're interested in that as well. So the two ways to reach me, if you want to call direct, 214-705-0124, or you can email me at david@irakeys, just like carkeys.com, david@irakeys.com. You're gonna see this number and the email address on the next slide, and I'm going to end there. So if you want additional information about the online distribution training course, or you're interested in the book with your photo, bio, logo, contact information on the cover, call me. I'm David F. Royer. There's the number, and my email address is right below. Don't forget to tell me that you were on this WebEx sponsored webinar to get the 50% discount off the course. Ladies and gentlemen, we ran, I guess I was talking fast. We're finishing 11 minutes early. I want to thank all of you for taking your time to be on today. We're now penetrating into the second half of 2018. And folks, I wish you the strongest finish of 2018 ever. Have a great day. Thanks again for being on, and I look forward to getting your calls and emails.